So, will the next budget bring changes to capital gains tax? That's probably the biggest tax question in people's minds ahead of the 27th of October. What we absolutely know, of course, is that the Office of Tax Simplification have made two reports on capital gains tax change. And the first one had some pretty radical suggestions in it. I've referred to them before, but just to remind you, capital gains tax rates should be aligned more closely with income tax, but with a reintroduction of some form of inflationary relief. That was one suggestion. The one that's caused most worry, to be honest, amongst the tax-paying public, the capital gains tax-paying public. A reduction of the annual exemption to a true de minimis level in the range between £2,000 and £4,000. A review of business assets disposal relief, used to be called entrepreneurs relief, of course, and the removal of the tax-free rebasing of capital gains on death. So basically all the past gains wiped out for tax purposes. They're the things that gave rise to concern ahead of the last budget, and especially the first one. If the tax rate doubles, I should think very carefully, say potentially CGT paying individuals, about making a disposal before the budget to actually bank the gains tax at the lower rate. Right, so what are the things in the context that we're living in currently that we also need to take into account, that the Chancellor may also have in mind? Well, the number of individuals who paid CGT in the last reported year, 2019-2020, were only about 250,000, so not that many people. The total receipts from CGT in 2021 were just over £10 billion, so not insignificant, but not the greatest tax yielder of all. And of course, the other thing to take into account is that the Conservative government is coming under strong pressure from the backbenches over the tax and national insurance increases that they've just announced. So all those things are underpinning the potential decision, and many moving parts. So what I want to do in this video is to just give you, in my opinion, are the factors that would push us towards suggesting there might be a change to CGT, and those that would really militate against a change to CGT. So those that lend us to think there might be a change, that support a potential change in CGT, is one, the perception of fairness in selecting who bears the largest burden of tax increases. And that's politically important. And until now, obviously most recently, the national insurance changes are those that have attracted most attention and the most negative attention, saying it's putting the burden on those least able to bear the cost. So relatively few people, number two, pay capital gains tax. So making the tax tougher and increasing the yield might not have a higher political cost. You wouldn't upset that many people. The current Chancellor, of course, did ask the OTS to review it, so it's something that was in his mind. Fourth thing is, taxing capital gains as income isn't anything new. We've done it before. It was the way of it up till 2008. Number five, if the yield were doubled, then another £10 billion would be quite appealing. The point though here is, and I'll mention this in the process, that it's not guaranteed you would actually get that £10 billion because of the way the tax is calculated. The likelihood that there'll be no one-off or annual wealth tax leads us maybe to conclude that the Chancellor might be more prone to thinking, let's reform the existing wealth taxes, basically the capital taxes, capital gains tax and inheritance tax, rather than introduce a brand new, complex, and as has been proven to be the case, not very efficient wealth tax. And that's also very much against Conservative philosophy, a separate, new, very clear wealth tax. However, the Treasury Select Committee has stated recently there is a compelling case for a review of capital taxation. So they're the things I think that push us towards thinking, well, there might be a change to capital gains tax. Things that would make us think, no, there probably wouldn't, is the concern, the political issue, which is concern over backbench and Conservative revolt, effectively anger over yet another tax change. The relatively low yield, I mentioned 10 billion is not to be sniffed at, but it's a relatively low yield compared to the other taxes, certainly compared to national insurance. Then there's behavioural factors of being insufficiently sure that you would actually get that yield. If you doubled the rate of CGT, would you actually get another £10 billion? Because people would change their behaviours to try to avoid it more. And that tax is a little more avoidable than national insurance. And of course, the fact that it's linked to values as well. So it's quite volatile, the capital gains tax. Values go down, the capital gains that you realise are going to be lower, and the yield is therefore lower. So they're the things, pros and cons. So is there going to be a change? On balance, the one thing I think we can be sure to say that you cannot absolutely and categorically rule out a change to capital gains tax in the upcoming budget. So it's not something you can just dismiss. However, whether it's something that should encourage you to take action, particularly by virtue of a disposal of assets ahead of the budget, is another matter. One question before dealing with that, one question that is sometimes asked is, if a change were made, would it be, or could it be made overnight, or would it have to wait until the beginning of the next tax year? History gives us a little pointer here. George Osborne increased the CGT rate by 10% for higher and additional rate taxpayers at midnight on budget day in June 2010. Would there be a need for consultation? Very possibly. If they felt strongly enough about it, there could be some anti-forestalling measures to say when we actually decide how this tax change is going to take place, it will take effect from midnight on budget day, possibly midnight on the day before budget. So against all of that and the inevitable, unavoidable, effectively, uncertainty, the one certainty is that, as I said, change can't categorically and confidently be ruled out. So should you bank disposals pre-budget to bank a 10% or 20% rate, or an 18 or 28% rate on property? Well, it's a very, very difficult one. I think if you're going to make the disposal anyway, if it's commercially right, if it's economically right, and you can do it from a logistical standpoint, might be tricky if you haven't even thought about selling your property yet or selling your business yet, pretty much impossible. Then if it's right economically and commercially, then absolutely it would make sense to do it. And you're going to do it imminently anyway, do it before the budget. Pretty much a no-brainer. And in addition to making the sale that you were going to make anyway, in addition to that, you may bank the benefit of a kind of little windfall tax saving if the tax rate does go up. If you're thinking of making a disposal purely for tax reasons, then you need to take into account very carefully the fact that you would definitely trigger a liability on the gain to the extent it exceeds the current annual exemption, and that will be payable in January 2023. That's a known fact, which you might not have had to do, which you wouldn't have had to do if you didn't make the disposal. And you might not get the win, because if that tax change, that tax increase that you're scared of doesn't come through, then you've achieved nothing except bringing forward the tax liability. Then you've got the commercial costs of actually making the disposal. And of course, the thoughts around then, if you didn't really want to dispose of the assets economically and you'd still like to be invested, acquiring those assets back in a way that still makes the disposal relevant and effective. So all of that would probably lead you to think very, very carefully before making a disposal ahead of the budget, purely on tax grounds. What's right for each individual is really, really a subjective issue. Basically, the bigger the gain and the greater the concern you have. So that's very individual around you as an individual, how you feel about that potential tax change. The size of the gain and the strength of your feeling are the two things that are going to drive your decision one way or the other. As an advisor, all you can do is advise the client of the facts, those underlying drivers that are both positive and negative in relation to change, and keep them up to date with any harder information that's coming through. But it's very hard, if not impossible, as an advisor to recommend a disposal purely on tax grounds to have the chance of banking a gain at a lower rate of tax. We will be keeping you up to date with all the news on capital gains tax and the potential for change, any harder news which is unlikely, ahead of the budget through Techlink.